Bonjour. Welcome to Wahsa Distance Education Center's radio Zoom classes. This is MEL3E, grade 11 workplace math, and I am Bronwyn Slade. If you'd like to participate live today, you can call the Wahsa studio at 1-800-465-7144 or 737-4017. Then you can ask me questions if you'd like. You can listen on the radio at 91.9 FM or on the television at Bell Express View channel 972. You're always welcome to join me live through the Zoom link, which is available from your teacher and also your DEC. Our classes are scheduled Monday through Thursday from 9 till 10 in the morning. And we are in our 5th week of our 9-week course. At this point, you definitely should be submitting some work for marking as we are halfway through our material. But a reminder that the support questions, the ones marked with the pencil icon, are not for marking. So you decide which ones and how many to do. You're encouraged to do all of them, but if you are understanding a concept, feel free to skip questions. You don't have to do them just for the sake of doing them. If you're good to go, then spend your time on something else. But also, if you need more practice, please ask and I can send you some more practice. The key questions are the ones that are marked with the little key icon, and those are the ones to submit for grading. So please do all of these questions, showing all of your work, your steps, and your thinking. This way, if you are making mistakes, I have more of a chance of understanding why you're making the mistakes and possibly give you part marks. And also then I can help you and support you in figuring out what's off. So the more information you give me, the more I can understand what you understand and help you. There are 3 methods for submitting your work. The first is to scan and send it in electronically. So scan your completed work in using a smartphone. The iPhone has the Notes app has a scan function, and the Android Google Drive app also has a scan function. So you can use those. If you need help with it, let me know and I can help you. If you don't have a smartphone or you don't want to use those, it's not working for you, you can also take a picture. That's fine. It means the files will be a little bit bigger, but it's not the end of the world at all. Then you can send them to me either through email at studentwork@nnec.on.ca and CC it to bronwyn.slate@nnec.on.ca, or you can send it to me through Facebook Messenger at bslatewasa. The second method is to drop your work off in SuLookout. So we have an outdoor mailbox at our location 74 Front Street. We're the bright red building next to the post office, and we have a small white mailbox next to our side entrance. And then the third method is to hand your work into your DEC. Your DEC can either send your work through the Express or fax it to 807-737-1732 or toll-free fax to 1-800-463-7852. If you'd like to connect with me through social media, both my Facebook and YouTube are under the name bslatewasa. If you friend me on Facebook and subscribe to my YouTube channel, then you'll get notifications every time I upload one of our lessons. So I record our lessons and upload them to YouTube shortly after airing. So you can watch them on replay, you can pause, you can just watch different parts if you'd like to. So that's a great way to access it again. There's also short videos explaining common errors and confusing concepts that I've uploaded onto the channel. This just is a good place to check out if you're struggling with something. There might be something there that helps you before just doing a general Google search or internet search. If there's something that you'd like me to explain and maybe possibly put a video up there, I can do that as well. So just let me know and I can make more videos. Math is really visual, so I highly encourage that you connect to the videos, either joining me live through Zoom. You don't have to talk to me, you don't have to ask questions, but just watching, you'll get the full experience. Or if accessing the YouTube replays is really going to give you the most information and help you understand the best. If that doesn't work for you, if you don't have time or reliable internet to access those videos, let me know and I can send you a USB key with the videos on them so that you can still access them. If you have any questions or concerns, please reach out and contact me. My email address is bronwyn.slate, which is spelled BRONWYN.SLATE@nnec.on.ca. You can also connect with me through Facebook, where my name is bslatewasa, You can call me at the office at 807-737-1488, extension 2209. I do have access to my voicemail now, so feel free to leave me a message and I'll get back to you. Or you can also call us toll free at 1-800-667-3703. My office hours are Monday through Friday, 9 a.m. to 4 p.m. So I'll get back to you within those hours. All right, so we are starting our first lesson of Unit 3. And this lesson, so lesson 11 is about credit cards. So our learning goal for this lesson is that at the end of this lesson, you'll be able to make and justify decisions about borrowing from credit card companies. You will understand the various credit card costs, and you'll be able to explain the effects of carrying a balance on a credit card. You know you've met the success criteria because, you've met the learning goals because the success criteria are that you can identify the pros and cons of credit cards. You can explain annual fees, APRs, cash advance fees, and minimum payments. And you can calculate the cost of carrying a balance. All right, so let's first, before we dive deeply into credit cards, let's activate our brain with some mental math. I don't believe in mad minutes where you just memorize facts and regurgitate them as fast as you possibly can. I don't think that helps us to learn. If you have them memorized, then you do well. If you don't have them memorized, then you don't do well, and it doesn't actually help you understand or learn the math facts. So instead of that, we focus on developing strategies that we can use in various situations and that help us understand why it works and that are flexible and make sense for each of us individually, even if we do it in different ways. So our question today is 51, take away 26. And we're going to use a strategy of constant difference. So what this means is 51 take away 26. Those are not very friendly numbers generally. But when we're talking about subtraction, there's a couple of different ways that we can think about it. And this way that we're thinking about it today is we're talking about the difference. So how much is between the two? So we're trying to figure out that 51 and 26, we're wondering how much space is between those two numbers. That's what this is asking. Well, that is they're not friendly numbers, they're tricky numbers. But what we can do is we can shift, if we shift our same amount down 1 unit, and so we're doing 50 take away 25, because I shift 51 to 50 and I shift 26 to 25, that distance is still the same amount of space is between those 2 points, but I've just shifted it down a little bit. And 50 take away 25 is a friendly number, is something that probably we're fairly familiar with, most likely with money, but that there's 25 units between 50 and 25, right? 50 take away 25 is 25. So the same thing applies because we shifted both of them down once, 1 unit. That means that between 51 and 26, there also is 25. And that's what it means by constant difference, is that we're having it's the same amount of space between the two numbers, but we're moving it on our number line to friendlier numbers. So 51 take away 26 is equal to 25. Okay, mine's on. So today's Mind On isn't necessarily prior learning. You might not know this already, but it's something that is important to understand and doesn't really fit quite within our unit. So I just thought I would throw it in here to sort of get us thinking about credit. So I want to talk about credit ratings and or credit score, they're both called. So your credit score is a 3-digit number that represents how likely a credit bureau thinks you are to pay your bills on time. So the whole point of your credit rating or score is saying if it's a high score, then the credit bureau, the credit industry says, yes, this person's going to pay their bills on time. They're a good bet. They're a good person to loan money to. If you have a low credit rating or a low credit score, then they're saying, this person historically has not paid their bills on time. So they're a risk. It's not a reliable bet that they're going to pay the money back or they're going to pay it back on time. Or we just don't know because they don't have any credit. history. We don't have any history. We don't have any information about it. So your credit rating is an important part of building your financial confidence and security. It's an important part of living in a capitalist system where we are going to need goods and services. And so credit and being reliable is something that comes up. So there's two main credit bureaus. Equifax and TransUnion are the two places in Canada that monitor, have access to all of your bills and all of your loans and all of your ways that, not all the ways that you spend money, but the ways that you are spending, like credit, where you're borrowing money and paying back, like that. So they track it and they can give you a credit report if you ask for it, or also when you are applying for a loan or something, then they check your credit and these are the places that they ask for that information. So how to maintain or improve your credit score. So how to have a good credit score or how to make it better if you have a lower credit score. First is to establish a credit history. So some folks think that, oh, I just won't have any credit. I won't get any credit cards. I won't put any bills in my name, and I won't have bad credit because I don't have any credit. But that means that if and when you would like to buy a car and you need a car loan, or you'd like to buy a house and you need to get a mortgage, there's no record of the fact of how you spend your money, of whether or not you are able to be reliable. And so you're less likely to get these loans because you're questionable. It's potentially a risk because they don't know. So having a credit history is really important. So often younger folks can get a credit card for a student at a student rate. And that can be a useful way to start getting a credit score, but you have to then use it responsibly. So just having a credit card is not going to get you a good credit score. You have to use it and pay it back on time. And then, so we'll talk more about how you do that effectively. So then the second way to maintain and improve your credit score is to pay your bills on time and in full. So instead of only paying the minimum balance or paying half of it, you want to pay all that you owe and you want to do it on time. It takes some processing time, so you need to always remember to do it a few days before the bills are due. If you're paying it online or sending a mail, like mailing a check or something, or paying it even at your bank, it takes a while. It can take 3 to 5 business days to process. Often it can be faster, but you just don't want to assume that it's going to be faster, because then your bills are going to always be, if you pay it on your due date, your bills are always going to be a couple of days late, which is going to affect your credit score. You want to avoid applying for too much credit. So you want to have some credit in order to build credit history, but you don't just want to ask for more and more loans, more and more credit, because that's sketchy and it's going to be a red flag for different financial businesses and such. So you want to, what's reasonable, you want to think about what you need and stick with that. And then you want to stay within your credit limit. So when you do have a credit, we're going to talk more about what a credit limit is, but you don't want to overspend. You don't want to say, okay, this is how much my credit card has $1,000 on it, but I constantly am spending more than $1,000. And so then you're going to get fees. And also that's going to be a red flag. So if you're finding that you need more credit than your credit card allows, then you should apply for a credit increase so that you're not always over your limit or not always close to your limit. It's not good to be close to your limit. You want to have space. So here is how the credit score range is. So it is a number between 300 and 900. I don't know exactly how those numbers are generated in terms of the mathematical calculations. We don't need to understand that, but we need to understand that your number is going to be between 300 and 900. Basically, nobody has 900. You don't get 100% perfect credit. That's just not how it works. But anything above 660 is really good credit. It's very good or excellent. So you're most likely to be approved for most credit products, and you'll receive a good interest rate. It doesn't guarantee it, but it just makes sure that it's a really good chance that you're a good, reliable person to lend money to, and because you're going to pay it back on time. And so you're a good investment. A good score is between 660 and 624. And that means that you're most likely going to get approved for credit, and you'll have okay interest rates. They'll be fine. Then below that, between 560 and 659 is fair, a credit score, and between 300 and 559 is a poor credit rating. So with a poor credit rating, you're probably going to have a really hard time to get approved for any sort of loan or credit. Sorry. And you might have a really high interest rate because you're a risk. You're not a good bet. With a fair, you're similarly that you might be approved for some products, but not as many products as if you have a good rating. So this is something that does really have an impact on people's lives, and it's something to pay attention to. You don't want to be constantly checking your credit because that impacts your credit score if you're constantly looking into it. But sometimes banking apps have an option where you can look to see what your credit score is, and it updates every few months. And that if it's through your bank, it might not actually affect your credit because of how it's set up. So that's something worth to look into, to just be informed. It's good to be informed. All right, so let's engage in these new concepts about credit cards. So when will you use this in real life? So we're trying to make connections and seeing patterns. It's within this course, we're constantly trying to see how this math connects to our real life. And when we're seeing those patterns, then we can make decisions and inform choices about the way that we're spending money or interacting with the world. So that's overarching in our course. Okay, so how do credit cards work? So a credit card is tied to a credit account with a financial institution. So when you use the card, you're borrowing money from the credit card issuer. So it means that you don't necessarily have this money up front. You're not getting it out of your bank immediately. You're not withdrawing it like debit where you take it immediately out of your bank account, but you're putting it on credit so that you're borrowing it from a financial institution. You can use a credit card to purchase many goods or services with any merchant that accepts credit cards. So people will accept credit cards, and they could be different. They might accept one and not the others, or they might accept them all. With technology now, there's more and more ways for small businesses or individuals to be accepting credit cards, whereas before it was harder. You had different machines for what you needed, but now with technology, there's many accessible machines that can connect to your phone and things like that. And there's three main companies in Canada of credit cards. I don't know apart in the rest of the world. I would assume in Canada, the US, these are the three main companies. So there's Visa, which the logo, it just says Visa. There's MasterCard, which logo are these two red and orange circles. And then there's American Express, which again, the logo just says American Express. Then these companies, not only, so these are the financial companies, but like the credit companies, but they can then put their type of card through various places. So they could be through banks. So your regular bank, you can get a credit card that's associated with either Visa, MasterCard, or American Express, but it's still through your bank. Also credit unions, the same way, that it's one of the major credit card companies, but it goes through your bank. Or also sometimes retail stores, so like Walmart or Costco, or various other stores, you can get one of these main. It's not like it's a store credit card, but it gives you points, or it's connected to the store while also being one of the major credit card companies. So we need to understand a bit of vocabulary so that you understand what I'm talking about. So the first is the credit limit. And this is the maximum amount you can owe at one time. So the maximum amount that you can borrow is your credit limit. And it can range anywhere from like $300 for like a youth or a starter card, or it could be up to thousands of dollars. You don't necessarily want to have the lowest credit limit or the highest credit limit. You want to think about what makes sense for you and what's reasonable for you. The second term is balance. And so this is the amount that you owe on your credit card. So how much you spent and how much you owe. Available credit is the difference between your credit limit and your balance. So credit limit is how much you're able to spend. Balance is how much you've already spent. Available credit is how much left you have to spend. Then the APR is your annual percentage rate. So this is the annual cost of borrowing money with your credit card. So basically it's your interest rate. Advance is when you take money, you take cash off of your credit card. So instead of buying something with your credit card, you take it to an ATM and you get cash out off of your credit card. So you're borrowing money off of credit. This usually has really high fees, and it starts charging you interest immediately. So there's no grace period, which we're going to talk about later. So I strongly advise you not to do it. Cash advances are not from credit cards, are not a good option. They're going to cost you more than they're worth. Of course, there's always situations that are emergency or people have different lives, but I strongly discourage you from doing cash advances. It's going to cost you a lot of money. Balance transfers are another thing that you can do. So this is when you move your balance from one card to another card, and then you often receive a lower interest rate or some sort of deal. So this may be within your same, Visa might be offering you a new card with other features. And so they say you can transfer your balance from your old card to this new card, and now you don't have to pay interest. Or if they're trying to get you to buy one from, like, sign up because you don't have a Visa and they want you to transfer it from a MasterCard or something, that can be, so you're transferring your balance from a different card. Then your minimum payment is the minimum amount you need to pay by the due date, or else you'll be charged a fee. So every month when you're paying your credit card, you don't have to pay all of the money that you borrowed, but you have to pay a minimum amount. And if you don't pay the minimum amount, then you'll be charged an extra fee. And if you consistently don't pay the minimum amount, then they're going to cut you off and you're not going to be able to borrow more, and your credit score is going to be really affected. Again, your credit score is the number that rates your credit worthiness. Okay, so why would you even have a credit card if it's cost you a lot of money? So in emergencies, sometimes you need to borrow money in order to survive an emergency. It's unexpected and you just need a bunch of money in one time. So having a credit card could be really helpful. If you're trying to buy a big ticket item like furniture or large TV or going on a trip or something like that, and you don't have all the cash up front, then using a credit card and paying it off over time can be useful. Establishing your credit so that you can borrow other things in the future. It's safer than cash. So it's harder to steal a credit card and use it than it is to just steal cash. If you want to buy plane tickets or stay at a hotel or rent cars or things like that, often you need a credit card in order to put down a deposit or to just sort of hold that space. So you can't pay for these things in cash usually. So having a credit card helps you to do that. And then also it offers you a certain amount of protection from fraud if you're on the internet, if you're online buying things. So that can be really helpful. They often have various fraud protection plans so that if someone uses your card on something that you didn't want to buy, or like your kid gets a hold of your card and buy something that you didn't want, then the credit card company might be able to get you that money back to protect you. Within credit cards, the interest is calculated using the compound interest formula. So it's not simple interest, it's compound interest like we talked about before. So just a reminder that is A equals P times 1 plus R over N, all to the exponent NT. So this is going back to lesson like 8 and 9. So where A, remember, is your final amount, your P is your principal borrowed, your R is your interest rate expressed as a decimal, your N is the number of compound periods per year, and your T is your time in years. Generally for credit cards, your number of compounding periods, it's compounded daily. So it's 365 is generally what your N is, just to know. Okay, so when you are getting a credit card, you need to apply. There's an application process so that they can decide if you are a good bet or not when you are applying for a credit card. They need some information. So this is on page 3 in your IEL book. So here is an example that I found online for a Scotiabank credit card application. So it says here at the top, it says, please bring the following items when you want to submit your application. So you need 2 forms of government ID, for example, a passport, a driver's license. They'll probably have a list of various options that would fit as your 2 forms of government ID, a utility bill or something that proves your address, proves where you live, and then a job letter or a pay slip, something that says that you have an income and what your income is. So then you fill out your name, your first name and your last name, your address, your mailing and your street address. This is important. Really funny. Here it says state, but then postal code. So we don't have states. We have provinces or territories, but postal code doesn't imply that it's Canada. Anyway, sorry, random thought. The reason that they want your address is to help protect against fraud, so that you can't just have a post office box. You need to have a physical address so that they know. It helps the company protect about identity theft and against fraud, because credit card fraud is a big thing where people apply for credit and borrow money, and it isn't actually their name they're applying for. And they don't necessarily live where it is that they're applying for. So it's a way to steal money. So having a physical address is part of how the company protects itself from fraud. Then your date of birth, so that they know how old you are. I can't remember if you have to be, how old you have to be in order to get a credit card. It's at least 18. It could be higher, but I think 18 generally. So that just confirms how old you are, how long you've lived, where you currently live, and your marital status, your phone numbers, your passport or ID number if you have one. Again, this is just for identity, to confirm your identity. Your mother's maiden name, I assume, is probably a security question. Often that is a security question that companies put, which is random to me, but anyway. Your employer, what your occupation, what you do, and your work phone number. How long you've been with that employer. Is it full-time, part-time? If it's been less than 2 years, then how long were you at your previous employer? Do you jump jobs a lot? That makes you not seem like a very reliable, consistent person. What your monthly income is, so that would be your gross income. And then any other monthly income, if you have any like child support or other part-time jobs outside of your primary job, things like that. So they want to know your employer so that they know that you have a steady source of income, and they can verify that with the employer, and how long you've been there to see if you have some steady financial reality, and then how much money you actually make. So then if you want to have a co-applicant, so for your spouse, you and your spouse can apply together, and that might help with if you have a low credit score or a lower income, then applying together might improve that chances. And then they want to know your financial information. So they want to know in terms of if you're a homeowner or a renter, and how much your property is worth, how much you owe on your mortgage if you own a home, and who lends you that money, who lent you that money, and how much your monthly payments are. If you have other Scotiabank loans or other credit card loans or other personal loans, they want to know that and how much your monthly payments are, because they're trying to gauge they know how much money you roughly make in your income, and they want to know your roughly not deductions, but payments, to see if you can afford or if you're already stretched. Then if you have any other assets like a car, so what the value is, and if you have any monthly payments on that, and any other savings or investment, how much those are worth. And then they want you to, if you want insurance on your credit card, you would check that. And then reading the fine print is always a good idea, even though it doesn't necessarily make a lot of sense, but let's just read it to see if we can understand it. You understand that to be eligible for coverage, you must be 18 years of age and under 70 to enroll, and that your coverage will be bound by the terms and conditions stated in your certificate of insurance. Furthermore, you authorize the bank to provide the insurer with your Scotiabank credit card number, monthly statement balance, and any other necessary information. And you authorize the insurer to charge monthly premiums to your Scotiabank credit card account. So this is just saying that you're agreeing to that you're between 18 and 70 years old, that you're going to follow the terms and conditions, and that you're allowing the insurance to charge you money on your credit card and access to your information. Then this final paragraph is everything I've said is true. So I, or we, there's two of you, hereby certify the above information to be true and complete. If this application is accepted by the Bank of Nova Scotia, the bank, I or we request the Scotiabank credit card and convenience checks to be issued to me as designated above. I hereby authorize and consent to the bank obtaining further information about me and checking the information I have given here and exchanging information about me with other parties. I agree to read and be bound by the Scotia credit card cardholder agreement, and I authorize the bank to debit my credit card account from the amount of the annual fees in effect for the time to time for the card. And then you sign it and date it. So that's how they might look slightly different depending on the company, but that's generally what an application is going to look like. You can possibly do it online, but that's sort of the information that you need when you're applying for a credit card. So you should be able to do the support questions now on page 4, questions 1 and 2. All right, so the next thing is choosing a credit card. What is that involved? What should we be thinking about? So when you're looking for a credit card, so this is also on page 5 of your IEL book. So I encourage you to look for a lower or manageable interest rate. It doesn't necessarily have to be the lowest. The lowest isn't necessarily going to be the best, but something that seems reasonable for your life. I strongly encourage that you have no annual fee. So some credit cards will charge you a fee every single year for the privilege of using their card. And when you're starting off, I would say, don't do that. And even so, like the credit card that I've had since I was probably 18 or so, has no fee. So for almost 20 years, I haven't been paying a fee, which just adds up over time. Having a free credit score tracker, which is under FICO. So you can check your credit so that you know how your credit's doing without it being a charge or a ding against your credit score. Having no or low security deposit, so not having to pay a chunk of money to confirm that you're going to pay back your credit. So just that's, again, going to be a higher investment that probably when you're starting off isn't necessary. You can look at rewards in terms of, there's lots of things that are like cashback rewards so that you get a chunk of money back at the end, depending on how much you spend. It's not usually a ton of money, but it's some. Also, you can have it could be a gas points so that maybe you get deals on gas or on groceries or on flights, on air miles sort of thing. There's various different reward programs. And so looking at that to see if that one of those things makes sense is something to consider. And also considering where you're going to use it. So if you're going to shop at Costco all of the time, then getting a Costco card makes a lot of sense. Or if you're going to shop at Walmart a lot of the time, or if you're going to be going on a lot of flights, having a credit card that works really well with flights and in different places in the world. If you're going to different places in the world, that makes sense. So that's just something to consider about when you are picking a credit card. So you can compare. I'm going to take you to a website where you can compare all the various kinds of cards in Canada. I don't know if this is going to give us all the cards, but we're not going to look at every single one anyway. But you can pick if you're looking for travel points or hotel credit cards only, or cashback credit cards, or just what are the most popular credit cards. You can narrow that down here. And then they tell you what the credit card is, the card type, which you may understand or may not, which is fine. The annual fee. So this credit card has an annual fee of $120. So you pay $120 without, just for using the card, not for any purchases, just for having the card. If you have an additional card, that costs you $50 a year. And then the interest rate is 20.99% for your purchases and 21.99% for a cash advance. If you do foreign transactions, that's going to be a 2.5% chance. If you have, it asks if you have minimum income, this one doesn't. Then it gives you bonuses. This is an air miles card, so it gives you bonuses in air miles. How you earn those bonuses, and then there continues to talk about various other bonuses. If there's any sort of insurance that's attached to it. So these are all just sort of extra points, extra information. So this, and then you can continue to scroll through and you can find lots of different cards. So here, this is an MBNA Best Western card. So it's a hotel card. It doesn't have any yearly fee or any fee for extra cards. It has a 19.99% purchase rate, but a 24.99 cash advance rate. So see, that's a lot higher. The foreign cards is 2.5%. And again, then it talks to you about various points for Best Western points. So if you're going to stay at the Best Western lot, that might be a useful card for you. So you can just go through here and it tells you all sorts of different cards, and you can just get more and more information about what might be good for you. Here are the cashback cards. So like here, the BMO cashback MasterCard is 0 annual fee, 0 fee for other cards. Your interest rate is 19.99% for purchases and 22.99% for cash advance. Foreign transaction fee is 2.5%. Minimum income, you don't need a minimum income. Whereas here, if you look at this other one below, the Cashback World Elite MasterCard, then you need to have $80,000 personal or $150,000 household income, which is just really different. And then you get different rewards depending on which card you sign up for, and you get a different rate of earning cash back. So the one where you need to have a minimum income and you pay an annual fee for, you have a higher earning rate of cashback amounts. So that's just part of how they work, how they want you to, why you might want to buy that credit card. So that's just a way that you can look to see those various different credit cards to understand what your different options are. Okay, so you hopefully can do the support question on page 5 now, question number 3 of choosing different credit cards. And now we're going to talk about delaying payments. So this is also on page 5 of your IEL book. So it's important to understand the cost of borrowing. If you do not immediately pay back the money you have charged on a credit card, they begin to charge you interest. So there's a legally mandated information box on every credit card application that spells out the associated and potential costs. So don't skip reading the fine print. It's really important to understand what you're committing to. So here is one example of, we're going to go through 3 pages of this information box so that we can understand. So first, they're going to tell you the annual interest rates. So there might be some sort of promotion at the top, promotion that's saying that what might be special. So for the first 90 days for this particular example, you get a balance transfer for 1.99% for your first 10 billing cycles. And your deposits are 1.99% for your first 10 billing cycles. So you get a deal if you're transferring balances over to this card. It's at a lower rate. Oops, sorry. Then, but standardly, most of the time, your purchases are 19.99%, your balance transfers are 21.99%, your access checks and deposits are 21.99%. I don't know what that is. That's something that I would have to look into more. And your cash advances are 24.99%. So after your promotional rates, that's what it's saying, that they might go up to these things faster if you're not paying your minimum balance or you exceed your credit limit. Then your balance transfers and deposits are going to jump up to 21.99% before the 10 billing cycles. Then here, this is really important, default rates. Your standard rates will increase by 5% if your total minimum payment due is late more than once within 12 consecutive billing cycles, so within a year. If you then pay each total minimum payment on time for 12 consecutive billing cycles, following the rate increase, then your standard rates will decrease by 5%. So they give you a chance that if you miss a payment, then more than once. So if you miss a payment once, okay. If you miss a payment another time within those 12 months, within 12 consecutive months, so it's not like it's just in one year, it's from like July all the way to the next June, right? Then they're going to increase your purchases by 5%. So that's 24.99%. If in the next year you pay your balance, your minimum balance payment for 12 months in a row, then they'll go back down to 19.99%. So understanding that is important. Then continuing the information box. So there's the interest-free grace period. And this is part that people are often confused about. So you will not be charged interest on new purchases for a minimum grace period of 21 days if you pay the new balance total in full by the total minimum payment due date for the account statement on which the new purchase first appear. You will always be charged interest on balance transfers, access checks, deposits, and cash advances from the date such transaction occurs. So the grace period only applies for purchases. So what this is saying is that if you have no balance on your card and you buy something, then you're not paying interest on it until the due date of your minimum payment. And then after your due date of your minimum payment, then you're paying interest on it. And all of your new purchases, because you now are carrying a balance, all of your new purchases will have interest on it immediately. But if you always pay your credit card off in full so that you don't carry a balance ever, then you never pay interest because you are always paying within that 21 grace period and you're never paying interest on it. So that's a really great way of using your credit card, is by just paying it off every single time so that you are building credit. You can access the benefits of a credit card, but you're not getting charged interest. So in your minimum payment, the total minimum payment is due will be the sum of the current payment due plus the past due amount, subject to a minimum of $15. The current payment due will be a sum of 1% of your total new balances plus all new interest charges. If your new balance total is less than $15, the minimum payment will equal the new balance total. So that's telling you how your balance, your minimum payment is calculated. Basically, you don't necessarily need to understand that, but just it's telling you that it's a percentage of your purchases. Foreign currency conversion, I'm not going to read all of this, but this is just telling you that if you are using your credit card to convert money to Canadian dollars, they're going to charge you a transaction fee to do that. And then for this particular card, there's no annual fee. So it just says none. If there was one, they would tell you about it there. And then if there's other fees, they tell you about it. So these are charged on the days the transaction or event occurs. So transaction fee. So for a wire transfer, 1% of the wire purchased amount, a minimum fee of $7.50. A balance transfer, 1% of the amount advanced. Access check or deposit, 1% of the amount advanced. And cash advance is 1% of the amount advanced. So you always are paying 1% of these purchases are always happening whenever you do these, plus the interest that's going to be added on after. Also then, if you have over your credit limit, so if you only have $1,000 or you're spending more than $1,000, you're going to get $25 fee for every billing cycle. If your payment gets returned, it doesn't actually process, then they're going to charge you $20. If you want an extra copy of your account statement, that's $2.50. And if you have an inactive credit balance, if your account is inactive and has a credit balance, you'll be charged annually on the date that your account was last active of the lesser of the credit balance, or $25. So if you just leave money on your credit card and don't use it ever, then they're going to charge you a fee. So that's why it's really important to read all of these information blocks so that you understand all of the costs. So talking about minimum payments are when you only pay the minimum amount that they defined. And so that means it takes longer to chip away at your total balance. Also, it means that if you don't pay the full balance, interest continues to be added to what you owe. And if the interest rate is excessively high, your minimum payment may not even cover the interest charged for the month. So it means that you're not paying down any of your payments, your purchases. It's just that you're paying interest constantly. So you're never going to finish it. So here is an example of a statement. Scotiabank was useful for finding examples. We're not going to read through everything, but we're just going to look at the general thing. So we have your statement date, when your statement was printed and when it is accounting for, and your account. So that's your credit card number. Then here, so payment due date is August 27th, 2019, and total minimum payment is $10. So this tells us that by August 27, 2019, you have to pay $10 in order for not to be charged a late fee. Previous balance is $0. That means that you paid off completely from last month. You haven't been carrying anything over. And so there's no interest to carry over as well. Then any payments or credits. So you paid $500. This is saying you're taking away $500. And then your new purchases were $923.52. So that means that your balance now is $423.52 is what your balance is right now. Here, your credit limit is how much you can borrow in total, which is $15,000 on this card. And so your credit available is $14,576 is how much you have available, which is what that plus $423.52 roughly is going to give you $15,000. Then here they tell you your interest rates so that you know what they are. That's always going to be stated so that you can always remember. And then if you have any rewards or something like that, that might be on your statement as well. Then it's going to tell you about your statements, about your transactions. So here is all that information that we read through again. So there's more and more information. This is a fine print that I strongly encourage you to read. It can be annoying and you don't have to read every time, but this helps you understand. And then here are your transactions. So you can see that they give you a reference number, when it happened, when it was posted to your account, where it was, and details about the company that you spent the money at, and then how much you paid. Here, down here, where it says payment, Bank of Montreal, $500, and it's got a minus, that's the payment that this person made. So that's how it shows up on your transactions. And then it tells you your, again, another place tells you your payment due date, how much you have to pay, and what your total balance is. So I'd encourage you to pay the $423.52 so that you don't carry over any of your balance and get charged interest on it. And then continuing, it tells you these are further transactions. It just, depending on how many transactions you have, it just lists them all. And then it also can tell you your interest charge, how much interest you were charged if you carried over a credit from previous, or a balance from previous months. Okay, so let's quickly do one question before we run out of time. So calculate how much interest John Doe will owe if he doesn't make any more purchases or payments until September 27th, 2019. So this is just a cutout of his bill. And so we have our balance. So if we don't pay any, if we don't make any payments, but we also don't buy anything else, so that means that our principal is going to be $423.52. Our rate is, because we're talking about purchases, so it's $19.99, sorry, 19.99%, so 0.1999. Our N is 365 because it's daily, and that would be in those information box. And our time is, so from August 27th to September 27th is going to be 31 days out of 365 because we're doing days per year. So then you would do your interest, or your amount is going to be your principal times 1 plus R over N, all to the NT. So it's equal to $423.52 times 1 plus your rate, 0.1999, all over 365 to the exponent, 365 times 31 over 365. So we do that on our calculator. So putting it into your calculator, just like we did before when we were doing compound interest, it's the same. I don't know why this isn't working for me. 0.1999 divided by 365. To the exponent. I'm just going to do exponent 31 because 365 times 31 divided by 365 is 31. So that's $430.77. So to find our interest is our amount to take away our principal. So $430.77 take away $423.52. So 430 take away 423 is going to be $7.77. Take away 52 cents is going to be 25 cents. So John Doe is paying $7.25 in interest for that month. And that's how you calculate that. So you can do the support questions on page 6, questions 4 and 5 now. So to consolidate for lesson 11, we've talked about how to apply for credit cards, how to choose a credit card, and what to pay attention to. And then the true cost of borrowing. So paying attention to your minimum payments, and that your interest is charged immediately on your balance in all new purchases if you don't make your minimum payment, and that you use your compound interest formula to calculate your interest. So hopefully at this point you can identify the pros and cons of credit cards. You can explain all of the different fees associated with credit cards, and you can calculate the cost of carrying a balance. That's really important. As always, if you have any questions, please reach out and contact me. This is a really important lesson to understand because credit cards are something in our daily life. So you can call, email me, or connect with me through Facebook. This will go up on YouTube shortly after airing, so you can recheck it out if you'd like to. I hope you have a lovely day. Thanks so much for joining me. Miigwech.